So will the Charleston real estate market crash in 2025? Hey, conventional wisdom says that when prices go up, especially really rapidly increasing like they did through 2020 and 2024 with COVID expansion, you would think they have to come down at some point. And we saw a big bubble in 2007 that burst. So is this like that time again? Is 2025 just like 2007? And here's the crazy thing. With the prices higher than they've ever been, we actually think prices are the most affordable that they have ever been in the history of money. And we're going to show you what we mean with some graphs from the federal government that shows how devalued the American dollar has really become. That right now, homes are actually more affordable for the devalued dollar than they've ever been. More than the 1960s, more than the 80s, more than 2000s. That this might actually be the time that you need to be investing in real estate is completely against conventional wisdom. No one else has seen this data, but you get a chance to see this before anybody else. I'm Matt O'Neill, CEO of Matt O'Neill Real Estate. I've got my business partner, Paul Kelton, here.
Hey, everyone. We are super excited to show you this presentation. We saw this at the National Association of Residential Property Managers Broker Owner Conference in 2025. We thought it was really important that we spend time to educate you on what is going on in the market right now.
All right, so this was a presentation given by Justin Anderson from a company called RentSmart. And Justin just did a masterful job showing us the economy, and we're going to show it to you.
So when you think of the traditional real estate market, there's a buyer's market and there's a seller's market. And this is typically how it works. So you start off with a seller's market and you have low inventory. And then you move into buyer demand increases. Prices escalate because of this, buyers exit the market. Then we see prices flatten, and then supply increases, and then you have high inventory. Then you have buyer demand is low again. Prices decline. Once prices decline, buyers start to enter the market again. Then we start to absorb supply from the increase in inventory, prices increase, and then you have low inventory again. So when you think about it, it's actually a cycle. But that cycle is done over time. So it's actually a wave. And it repeats. We have a buyer's market and then seller's market and then buyer's market. And when you look at it over time, it actually increases over time because the lows are never as low as the time before and the highs keep getting higher. So it's actually an uneven wave that we see going up over time. So you can really think about it in four different markets. You have seller market one, which is expansion. And then you have seller market two, which is equilibrium in the market. Then you have buyer market one, which is decline. And that's actually the start of the cycle. So you'll see buyer market one on this other side. And then at the bottom, you have buyer market two, which is absorption. This is what we call the millionaire maker because the people who buy at this time end up becoming millionaires from the equity that they receive in their properties. The difference between buyer market one and what leads into buyer market two is oversupply in the market. And what goes from seller market one to seller market two is job growth. That's what fuels it. The average phase is 3 to 5 years between each of these buyer market one or buyer market two, seller market one, seller market two. The average cycle to go through the whole thing is 12 to 18 years.
Yeah, so Paul, let's talk about where is this? Where are we right now in this market? Because we think back, what was 12 to 18 years ago? We're in 2025. 12 years ago was 2013. 18 years was more like 2008, 2009, 2010. So at that time, we were in a buyer market too.
Mm-hmm.
So the cycle would say that we should be getting back to buyer market two right about now.
Yeah, and when you look at the indicators, which we'll go through, you'll actually see what supports that statement. So in seller market one, we have low inventory, pricing's high.
Yeah, and this was COVID, right? Inventory was basement. Time on market was nothing. Pricing was going up at like 20% a year. Jobs, employment was amazing. All the investors were out. A ton of new construction, and there was no foreclosures. So that really is like the 2020 to 2023 was that seller market one, obvious.
Yeah. And then in seller market two, that's where we're starting to see, like, we have higher inventory,
Yeah,
Pricing
inventory
stays the
right now,
same.
inventory of houses right now, it was 900 houses on the market in seller market one. We're at 4,200 homes on the market right now. That's 400% more inventory. And it's been like this for about 2 years.
That's right. Yeah, absolutely right. We started to see the other key thing here is we start to see investment property activity start to slow down, which is what we've seen. It was on such a high for so long, and we're starting to see that level out. Next, we go into buyer market one. And this is where you start to see inventory increase. You start to see prices go down. You start to see employment go down. Investment property activity goes down.
This is the entire country, other than Charleston, South Carolina. So the entire country, we're starting to see employment drop and we're starting to see prices drop other areas of the country. So the majority of the country right now is in a buyer market number one. Charleston is still in a seller market number two. Prices are still going up, surprisingly. And we're going to talk about why prices are still going up and really our prediction that they will actually never come down through this cycle in Charleston. So, but we'll show you how that looks.
And then the last phase is just buyer market two. So we have inventory stays the same, pricing starts to go back up, investment property activity start to go back up. This is your millionaire maker. This is where we start to see things pick up again.
Yeah, when time on the market starts to drop. So we're seeing time on the market still in an increasing phase. So the country is in a buyer market one. Charleston, we think, is in a seller market two. Buyer market two will be the time where you start to see days on market drop and prices start to come back throughout the rest of the country. And that's the time that you want to get in. That's the best time to be buying. So
So
Paul,
is this
is it 2007?
is it 2007? Well, let's go through it.
All right, so this was interest rates. This is interest rates over time. We can see back here our graphs. This is straight from federal funds, from the federal pages, shared areas. What's the source? Board of Governors of the Federal Reserve System. So you can just go on fred.stlouisfed.org and you can get all of these graphs. They're straight from the federal government. Justin didn't create these. So this is just the data. All the data that we're going to see is going to go back to 1955 and is going to go through Q1 of 2025. So this is interest rates. The difference between this market and the past is that before 2007, interest rates were hovering about 6%. And over the past decade before this market, interest rates were effectively at zero. But the interesting part about this is people don't want to sell because as of June of last year, 89% of the mortgages are below 6% and interest rates now are at 7%. And 62% of mortgages were below 4%. That's why we saw interest rates the interest rates were so low for so long at zero that people don't want to resell their house right now.
Yeah, so this is talking about new construction that we see in the market. So as you can see in the run up to 2008 and 2009, an incredible amount of housing starts. They overbuilt. Everybody overbuilt for the housing inventory in the United States. We're just not seeing that on this side. We in 2024, 1.5 million housing starts. In 2007, we had 1.9 million exit units. In 2024, we have a housing shortage, 2.1 million units too short.
Now we're going to look at prices, and this is the most interesting way to look at what homes are actually worth that I've ever seen anyone do, and it's really surprising. So this is just straight dollars. The first thing we're looking at is straight dollars. So in 1965, you could buy a home for 20 grand, and at the peak, 2007, you could buy a home for 257,000. This is national average. Then it dropped about 20% to 208,000. It started to peak back up here to 222. This was the recovery of 2012, and then we saw another peak at the end of COVID of 442, and we've seen a little bit of a drop. Remember, I was saying the whole market is in a buyer market number one, where we're starting to see prices drop, just not in Charleston, but the country has been seeing a buyer market number one with prices declining. They declined from 442 to 420 in the last couple of years. And now we're going to look at Paul, what are these numbers, the 43 and the 559?
So the much more stable way of looking at value over time versus the dollar is actually to look at gold. So what these numbers are is what an ounce of gold is worth for these specific time periods. So $43.50 is how much an ounce of gold is worth. In 1965, $559. You get the point. It goes up to $640. Today, an ounce of gold is worth $2,925.10. So,
Yeah.
well,
Why gold is so important to measure is because the money is just funny money.
yeah.
It doesn't money the American dollar has been devalued at such a high rate, and we're going to show you why that is. That we're trying to figure out what is a home actually worth based on a metric that we can understand isn't changing the way that we can just print money. And gold is a metric that he's using to establish what the value of homes actually is. So
So if
here's the
you,
interesting thing is that in 1965 you could buy a home for 464 ounces of gold. The lowest, so the best time to buy actually was 1980, and there was I think interest rates at that time were like 13%, and you could buy a home for 113 ounces. But if we look at the crash, it was 400 ounces of gold to buy a home in 2007, and it crashed all the way down to 239 ounces of gold to buy a home. So you would think the second best time to buy a home in the history, the first best time was 1980 at 113 ounces of gold for a house. And then the second best time was 2007, which was 239 ounces of gold to buy a house. And, I guess it's 200 was our best case. Then at the peak of the market, when everyone said, oh, you shouldn't buy right now, it was still only 257 ounces of gold to buy a house. So the peak 2023, 2022 and the COVID craze, it was actually a better time to buy than 2007 by about double. But here's the interesting thing. Right now, Q1 of 2025 is the second best time in the history of these graphs, going back to 1950, to buy a home compared to the price of gold. It only costs 143 ounces of gold to buy a home, which is what, about half of what it was 2 years ago, and is far less than what it was even at the best time, even in the 2009 market, the 2010 market, the 2011 market, when everyone said, oh man, this is the market to make your millions. 2009 to 2012, that was the market everyone was buying because it was such a good deal. Well, it cost 200 ounces of gold to buy a home then. And today it only costs 143 ounces of gold to buy a home. So why are the prices so high? This is why. This is US currency supply. This graph blew my mind. We were on a gold standard until 1970. So meaning that the United States wouldn't print more money and we had to back it all up with gold. And it was actually illegal to own gold up until that time because we had to back up our money by gold. And then we decided to get off the gold standard because we needed money for the wars that we were getting into. Well, still the supply of currency didn't go that crazy. We were back at $200 billion of currency in 1970. By 2000, it was 1.1 trillion. And then by 2015, it was 2.9 trillion. So, that's 300% increase. But look at what happened as soon as COVID hit. We went from $3.8 trillion in circulation to $20 trillion of money in circulation. It is a straight up line from gradual growth of money in circulation over all this time to we printed 500% more money and distributed it to people. This looked like every single American got a stimulus check. I received one. Paul received one. All of our neighbors, every single person was given, I don't know, $2,000 to $5,000. I don't remember exactly what the stimulus check was. It looked like hundreds of thousands in PPP money. Our company was given $100,000 in PPP money that never had to be repaid. And other companies I know were given $500,000, $1 million, multi-millions of PPP. So where did that money come from? It was just printed. So we've seen everything go up in cost. Paul and I were just talking about this. To take our family to Chick-fil-A, it used to be $30 and now it's $90. One meal. You used to think, oh, I can get a meal for $10. You go anywhere, it's $25. So we can feel it, right? They're saying, oh, the cost of groceries is up. Well, home prices also doubled. But should they have gone up more? Absolutely. If we printed 500% more money in just a couple of years, home prices should have gone up more than double. This is where we're at now. We've seen the supply of money drop just a little bit from 20 trillion to 18.5 trillion. Paul, what was this slide?
So this is where he talks about how this is not like 2007, because in 2007, banks were only required to have 3% of the currency that they have on reserves,
Mm,
and they were able to loan out 97%. But
right.
in today's day and age, that's just not the case. They still have 17.44% of money on reserves. And that's what the Federal Reserve requires them to have. So this
Yes.
isn't going to be a situation where, someone defaults on the loan. There's a cascading effect across the banking system like there was in 2007. It's just not possible right now. So a lot of this money that we have that we printed, it is tied up in the banking system, but a lot of it is also in circulation.
Yeah, Americans have more money per household than they've ever had in the history, and I'm talking percentage wise, not just dollars wise. And they have more equity than they've ever had. So they've got cash and equity. And in 2007, that was not the case, and the banks were also insolvent. So where are we headed?
This is the golden age, not just of property management, but of owning property. Right now, we it is unlikely that we see an enormous decline of prices. It's just not going to happen. There's too much money out there right now. So when you look at the value of real estate versus the currency, the value is holding strong. The hard assets value is where you need to park your money, not in the bank, not in cash.
So this was mind-blowing information for me, and the whole point of this is that your dollar is still going to be devalued. And we, the speaker Justin, and looking at these graphs that we now have 500% more money just printed, we would think that the dollar would be devalued 5 times, meaning that prices should increase 500%. Now, he said they're probably not going to, because some of our dollar is backed by other countries that have our standard, and they've absorbed some of that. But if we've printed 500% more money, and houses are now, according to Gold, the cheapest that they've ever been to buy, he said you better be buying real assets and not selling your real assets, because they're about to double again. His prediction was it will, even though we've seen home prices double in just 5 years, he believes they're going to double again within the next 10 years. So if you don't want to see your money be cut in half, which it will, and it's going to be cut in half again, you put it into real assets and you watch it double in these real assets. What does this mean for investors?
It means that this is the time to buy. This is the buyer's market number two. This is where you need to be making sure, don't sit on the sidelines anymore. Start buying the assets. Even if they're barely cash flowing now, you will see that value continue to increase over the next 10 years.
Yeah, and we'll see rent rates go up because they have no other choice. Because
Yep.
inflation is going to continue to affect all of us. We're going to have to pay employees more. We're just going to have to. And then because we're paying employees more, the rent prices are going to go up because everything's going up, meaning that the asset that's barely cash flowing today is going to be cash flowing pretty well within a few years. But that same asset's also going to be twice as expensive. So what am I doing? Paul and I are like, holy cow, how can we buy as much real estate right now before everybody else figures this out? Before seeing this information so squarely, I was like, well, should we be putting our money in real estate right now? I mean, I did. I bought 3 rental properties last year because I thought I could see some pretty good deals. And we did deploy all of our available cash to do that. And now I'm like, man, I got to get more cash as quick as I can and get more assets right now, because everyone is thinking, oh, I'll just kind of wait it out and see, and prices are probably going to drop. I don't think prices in Charleston are going to drop. Everyone's been saying for the last couple of years that we'd see prices flatten. They rose by 4% in 2023. They rose by 4% in 2024. They're rising through Q1 of 2025, even though they're falling everywhere else in the country. They're continuing to rise in Charleston through this seller market number one. And I think that we're just going to see just kind of a mesh of seller market one and buyer market one here in Charleston. And then immediately it's going to go to buyer market two, where we see prices go up at a pretty rapid rate when interest rates ease. Interest rates will not ease right now, not in 2025, I don't believe. Interest rates might ease in 2026. And when that happens, you're going to start to see not 4% price increases, but maybe 10 to 15% price increases in the Charleston area. And so you would have already missed what I think is going to be the time to buy real estate in Charleston. It's definitely not the time to sell your investment property.
Hmm. Yeah, hold as much as you can. Make the numbers work for now. Just ride through the wave of this.
Yeah, everyone's going to figure this out at some point. Eventually, the talking heads in the financial world are going to like show these graphs and are going to talk about, oh wow, okay, it wasn't really a crash because we just created all this money. And then everyone else is going to figure it out, and then we're going to be in buyer market two where things are going up rapidly, and you're going to jump in too late, and that's okay. Jump in when you can jump in, but right now would be a really good time to jump in. It's what Paul and I are positioning ourselves to do personally, is to buy as much real estate at this moment as we can because we know our cash is getting devalued rapidly. All right, I'm Matt O'Neill. Paul?
Paul Kelton, thank you guys for joining us today.
Hey, if you want to reach out to us, you can get us at mattoneillrealestate.com. You can call Paul on his cell phone. Paul, what's your number?
843-460-3173.
All right, we're here to support you. See ya.
Thank you.